Welcome to the Cirrus Research Market Conversations. This is a series dedicated to conversations with institutional investors addressing all sorts of topics that basic investors care about. In this particular episode, we're focusing on quality, and we've got Pranav Ghai as a guest today to speak on the subject. In terms of his background, he is the co-founder CEO of Calcbench. And what is Calcbench? Calcbench is basically, they're the financial data platform for really detailed fundamental research. Bottom line, they're pretty serious credentials in finance, accounting, and applied math. I'll let him describe it a little bit, but his background, it's neat. He's got a background in applied mathematics with over 2 decades as being analyst in places like TIAA, Morgan Stanley, and ITG prior to forming Calcbench. He's also on the board. He's also a board member of XBRL US. And is on the Technical Computing Advisory Board for Microsoft. And finally, I'm also a member of the CFA Council that's focused on the quality of financial reporting. I think for those of you who have CFA questions, he might also be the person to reach out to. I'm joking, of course. But at this point, let me just turn it over and welcome Pranav.
Hi, Satya. Good morning.
Good morning.
Thank you and to Cirrus for hosting this. We're really excited to participate.
Yeah, we've been speaking for months now, and this whole subject of quality's come up. It's like front and center in some of our work. I think your team's expertise, the data you're looking at, I think we also look at financial data, but clearly on the accounting side, nowhere to the details you guys do. But before we jump into that, tell us a little bit about Calcbench. I think folks might want to know a little bit more about this. Yeah, would love a little of your story on it.
Sure. So thank you for that. We started Calcbench a little over 10 years ago, believe it or not. And the idea arose back in my Morgan Stanley days. I worked with a bunch of people who were focused on sort of the quality of fundamental data coming through our pipes in order to then have our analysts build models, et cetera, and then send those out to clients. And I kind of got hooked on this idea back then of like clean data leads to better models, which in turn, in theory, lead to better investment outcomes, right? Eventually.
We hope so.
Yeah. So that's where all of this started. And so one day, I was literally sitting in a coffee shop, hacking away some code, and one of my old colleagues from Morgan Stanley walked in, and we just struck up a conversation. And it turned out he was the head of this new thing called XBRL US, which is a nonprofit that basically took the entire US filing universe and electronically converted it into a machine readable data set. And he said, you can basically get access to all of the 10Ks and 10Qs beginning in 2007. And we were at this point sitting in 2011. You can get them, with a little code programming. And kind of I looked at him and said, wait a minute, Bloomberg, FactSet, Cap IQ, these guys all charge massive amounts of money to get this data. And you're telling me I can get it for nothing in bulk. And that's where Calcbench started. It was that conversation. A few days later, we had, my partner and I had an online income statement, balance sheet, cash flow for any company anybody wanted. You could just type in a ticker and like, boom. And it was as the company reported it, which is critical because there's no middle person in the way. IBM files their 10K, you type in IBM, you get it. And then if you want to compare it to Cisco, you could just do that on your screen live within seconds. And so it was this idea that you could get clean fundamentals. We were helped by the fact that cloud computing was at its initial start. And so we were able to get hosting services for relatively nothing. And we started this company literally out of a garage. And here we are 10 years later.
Very neat. Very neat. Over an interesting decade.
Yeah, that's right.
So yeah, I mean, I think, if we go back to this subject of quality and financials, it to me, I think the term quality is probably one of the most abused words in our industry. The quality manager, quality fund, quality company, et cetera. I think the one thing that made me realize how complicated this is when you hear the cocktail talk of I buy good companies, I like good management, love good balance sheets, and I'm like, okay. When we run empirically data, though, things don't line up as easily as you want to say it. So, for instance, classic measures like ROE, if I were to back test that as an investment strategy, a pure naive model, it's not terrible. It's really not. If you do a few sector constraints here and there, tweak it a little bit, you get good stuff. Leverage, though, the whole concept of a good balance sheet sounds great, but when you look at the results, the performance results, it's a sine curve. So yeah, in scary times, it works. And in good times, it's terrible. And so this idea of holding on to factors, that represent quality is important. It's much more nuanced than people want to believe. And I think the timeliness of this is critical because we've gone through this massive pandemic. I didn't mean to say in past tense, by the way, but we're going through this moment, and you've got central banks that have thrown so much capital into the system. It's sort of like saved the world possibly from falling over the edge, and at the same time created rates of change that we've never seen before across everything. And so this idea that the profit cycle, and I use it now with parentheses because, anything divided by zero is infinity. So over the last two years or so, your comps are going to be looking really weird. And so what we're finding, though, is that the profit cycle is legitimately maturing. You're no longer in that zero to hero moment. And at the same time, as the profit cycle matures, as we get through these reopening stages, we're coming back to fundamentals again. We're no longer whipsawed, as we call it, COVID on, COVID off, right? That's been the trade for 2 years. And maybe it goes a little further. I hope not. But the idea is that the reality is setting in. The Fed is starting to unwind its balance sheet a bit. What happens? Well, better balance sheets, more earnings visibility. These things are going to start to matter. It was no longer the home versus away basket. And so with that, I thought, we've seen a few interesting things in the marketplace. So for instance, the last 6 months, higher quality firms are starting to work better. They're starting to perform better. We're seeing a break in, given the rate risk that we're facing, we're seeing a break in innovation shares, right? So this growth world is starting to decompose a bit, and you're seeing quality growth do better, innovation starting to get hit. If I want to go further, though, and this is, I'd love to hear what you've got to say is, when you look at financial statements and the data, how do we guide clients better to think and smarter about the variables they're looking at? Would love just your overall observations on the subject, and then we can jump into some details.
Absolutely. Thank you for that intro. You're right about the whole buzzword bingo aspect of like this quality thing that we all talk about. Specifically, when we look at certain companies and sectors, really in our database, what we're looking for are particular. We do look for particular things, and our clients look for particular things. And what's increasingly evident the kinds of data that are available to people sort of at their fingertips that they were always kind of around, but now it's more prevalent, it's easier to get, and people really ought to use it. So some of those things, I'll just name a few here. For operating companies in particular, they have a disclosure inside their, it comes in the earnings press release many times, it comes in the 10K all the time, and it certainly comes in the 10Q as well. So you're getting this information quarterly, is the operating segment. So that's something that I think is really, really useful and particular, especially with bigger companies. When you talk about different divisions and what they look like in terms of sales and profitability, these things are reported at those operating levels. And you can ask some very basic fundamental questions like, give me a time series for this defense company. What did the aircraft manufacturing component profitability levels look like, right? And then you can compare that across the industry. And you can do it very, very quickly with very, very timely information. And so when you start doing things like this, you can, the whole, back in the old days, we used to say, look, is GE really a financial services company? Because they're in all of these different businesses. You can actually take apart the components of this thing and put it back together in a way that's much more meaningful and gives you, as the analyst, insight into where the profits really come from. And that's critical in understanding anything, right? So,
yeah, I remember being frustrated by this subject, that we had to break it apart and bring it back down to what is the operating cash flow, or what's the recurring cash flow.
Right.
And honestly, as an analyst or a student, it's a lot of work to get there, or traditionally, especially in school. Yeah. But it is crucial because there's so many ways to, throw you off. The net number is way too easy to take at face value.
That's absolutely right. And so what this whole ecosystem that, people like us have been involved with in the last 10 years or so allows, you as a user to basically write a simple formula, get that number out for a component of the business, link it back to the business, and you're off to the races. You can do that in literally seconds, right, today. So it's no longer going to the document, digging out where that number is, or going to the analyst model. You just write a formula, maybe change the date, or have it set up so that it gives you the time series for
dynamic.
Next quarter.
Right.
Yeah, it's dynamic, and you're good to go. So that's one area, and then there are plenty of other areas. Right. So pick.
So yeah, I mean, I think when we spoke a little bit about some of the subcomponents, if we start looking at the statements, and you brought up the subject of goodwill as well, other layers that we could see valuations get really distorted.
So goodwill's another. Every year we have a panel session where we put together some experts in various fields. We bring them together primarily because we were sitting there one day. We were like, hey, what are the cash levels on balance sheets? We just sort of put that out there. And so if you want to look at other things like debt, this, that, and the other, say, okay, what does the pie look like when you look at the overall balance sheet? And there's this big thing missing. And we were like, why is there a big hole in our pie? What's going on here?
Not a donut.
Right. And so it turned out it was a really, really big hole. It turned out there's this thing called goodwill. And it's actually the second largest component, besides cash, of corporate balance sheets today. And it is goodwill is just a construct. It is when a company goes to buy another company, there's a book value associated with the purchase. And it's the amount that you pay above book value for the purchase. And it just accumulates on the balance sheet. And it is staggering. this number. It's in the trillions of dollars. And it's real. Yeah, well, it's real because people paid this money to acquire the company. And so an example that I like that is actually almost already outdated, but it's recent. So 5-6 years ago, Microsoft bought LinkedIn. And everyone remembers that purchase because it was so big. It was $27 billion. And so that was a headline number, and you saw it. And like, okay, the Wall Street Journal reported it. It was in Bloomberg. It was everywhere. And then 6 months after the deal was announced, I'm going to say sometime over the summer in 2016. And then in the winter of 2017, the actual granular details of this thing came out. And it turned out that of the $27 billion, somewhere in the neighborhood of 16 billion was in this thing called Goodwill. So they marked 6 to 7 billion for the intangible assets, which is the intellectual property associated with this thing, maybe the customer lists or whatever. But then, like, over and above that amount, like, they just paid a premium, right? And so what we do is we actually, we disaggregate that too for our clients. So clients come to us and say, look, if I were to ask for all the purchase price components of every M&A transaction for the last 10 years, can you guys give it to me? And we actually have a way we can plate it to a client and show it to them.
I gotcha.
And now you can kind of start thinking about, okay, well, in pharma, what are people paying for patents, right? So that's the granularity now that you can do.
Wow.
And that's another function of real quality, right? So,
right. Neat.
Really neat. It's really cool. It's work, but we,
Yeah. But I mean, I think it's fascinating that this data is as available and addressable. The coder in me also loves the idea that these are addressable variables that you could begin to really mess with it, and then formulate it and then build it in as a recurring tool.
Right.
And so, this idea of goodwill, if you think about the broad markets and its impact on the financial statement, if you have share prices rising for 20, 30 years, if you have interest rates falling for 20, 30 years, if you're moving to a new rate regime, the risk that there could be some serious overpricing of assets.
Yeah.
When we think about this sort of trust me value, right? And so this whole, there's reason people are genuinely nervous about this interest rate moment. And is it genuinely transitory, or is there a little bit more to this? And I think this is this quality subject kind of rolls into sort of like the cyclical moment, but I think there's quite a bit more to it, and we can monitor it on our side with factors. What we won't do is get into that level of detail, but we will look at a skew of measures. So we can then grab companies like credit quality by some vendors' ratings. We can rank order the entire universe, small cap universe of almost 2,000 companies, mid cap of like 500-600 companies, and the rest, the most biggest companies are probably left over, maybe 400-500 companies left. We can rank order those quality constraint measures in each asset class, quintile them, decile them, and then measure performance, recalibrate once a year for 20 years. And what you begin to see is there are cycles of quality being rewarded and discounted. And what was fascinating to me was that the term we use here is pricing factors. What I mean by that is we can measure a quality basket, right? The high quality bin, let's say it's top quintile. But what we can do is not just measure the performance. We can then say, what's the average EV to sales of that basket? or PE or price to book. You pick your favorite flavor. Now what we can say is, hey, did you know that credit quality bin normally trades at 2x market multiple when it's high quality? At the lowest point, it's 0.7 in some super confident times. And guess what? Last year, higher quality firms, in the early stages of the vaccine announcement, they got clobbered and they went down to those discounts. And so in a way, we think of these things as timing factors as well. But yeah, I think this thing loops in really well. I've always, been challenged by, I hate it actually, to think about having to use financial ratios on classic industrial companies and then have to switch over to like financials and then have a fundamental analyst tell me, well, a biotech's just different. And I just hate it. But, are there sort of rules of thought or ways you guys think about the broader sectors and sort of like go-to variables without, going through too much, but like I said, I think it's a super important topic because you could save people a ton of time if you have a handle on what to avoid.
Yeah. So the industry level or sector level characteristics, what we did when we constructed our data set was to not ignore those components, right? So you have the ability to, you can construct from the bottom up, right, all of those, the components that would go into the factor that you were describing, right? Right. So for example, like when you're talking about services companies, you might want to consider labor costs as a percentage of operating expenses or something like that, right? And so we give the client the ability to say, okay, what are the labor costs of these companies? Assuming, of course, that like the companies quantified them, and many do. And then you can decide what to do with it. If you want to normalize it by total operating expenses or some other factor that you've picked, right? That's doable. Again, like we can go back to the segments for the industrial companies and something like that. We've had people come to us, and this is always really, really nice when they come to you and they say, hey, we've had REITs actually, the actual managers of the REIT come to us and say, we're looking for funds from operations for all our competitors. Can you guys have that? And we're like, yeah, here we go. So that's kind of fun.
It's funny what happens when you enter the public markets.
It is really funny because you can't, you have a different sort of appreciation for the way managers think, right? Like I never would have considered, the operating company is coming to us to be a client and ask these questions. And then you pick up knowledge along the way, like, oh my God, that's how we ought to construct the metric and so you pick up a lot of those things as you're building this stuff. And then, other things like in a high growth environment, there's a lot of capital expenditure going on. And so, we monitor that and give people the ability to pull it out. And so really what it's come down to is like there's sort of a basic bin of information, sort of in the old, Graham Dodd framework. And then there's this other emerging, KPI, the key performance indicators section. And that's relatively industry specific. And, it keeps us busy trying to manage both.
Right? That's neat.
And then give our partners and clients, hey, we'll put this stuff together for you, and then we'll help you build the mosaic that you want. Right. So that's sort of.
Yeah. I mean, it does sound though, like the flexibility to address this in a few verticals makes a lot of sense. In terms of this moment with the term inflation, I've got to think that one of the popular screens for right now might be, hey, let me focus on my service companies and let me look at some sort of labor ratio to revenues or something, just to rank order these things. And I mean, that would be, I would think, a way to isolate how inflation's hitting various industries or companies.
Yeah, and you can just, anecdotally, you can see it every morning when we come in. We kind of look, we look at, who filed today, who's already filed.
Yeah.
And the filings, the earnings filings obviously come in prior to the open and then after the close. Prior to the open, most of us here are sort of like, we're still with it. We haven't been flummoxed by the day. So you can see, as cost of goods sold come in, like just the rising levels of these things. And you're like, that's inflation rearing its ugly head. And, you'll see it. People say they see it in the call report transcripts. We don't go to that aspect. We don't, monitor the transcripts or anything, but you'll see it in the actual narrative within the earnings report. People, the frequency of the word even is increasing, and that could be, that's another lesser used kind of.
It's another tell.
Yeah.
Yeah. That's neat. That's neat. One of the things we stumbled, a conversation we had last week, I thought was neat. And you were sort of giving an example with a massive company like Amazon. And I thought I loved what you did there, because I thought it was a great case study on a lot of things we just talked about, but it's playing out in a super important company. And I'd love for you to sort of walk us through how you guys look at that that massive firm.
This is one of our favorites, and so it's wonderful because every quarter you come back to the story, and so like on the story goes on February 3rd, just that week, that first week of February, just a massive earnings week. Data is just pouring in, and these guys reported, and like after the market, their stock just rocketed up. I can't even remember how far up it went up, but I think it may have been like 10% in the aftermarket. The thing just skyrocketed. People were saying, "Oh, these earnings are just extraordinary. Look at this." And so we were like, okay, we've got the data. Let's actually look at this. And so we found, we like to look, and so if you look at a sort of a top level, you can see that their EPS number, take nothing else, it was almost $66 a share. It was up 55% from a year ago. So that sort of explains like the immediate initial sort of market reaction. But then you sort of peel back the onion a bit and you say, well, we have to take a closer look, right? And so one of the things we like to do is we don't focus on the EPS net income. We like to look at, let's say, operating income or cash flow from operations, either one of those two, just to look at the real operating metrics of the business. And you sort of strip out the exogenous stuff. And what I mean by that is, in the case of Amazon, they actually had a stock sale, or they were involved in the financing of this company Rivian, which is an electric vehicle producer, and they're involved in it for obvious reasons. That company went public, and if you look at their income statement down at the bottom, there's a sort of a one-time item there that was a non-operating income item for plus $13.3 billion. So that's not going to be recurring, right? In fact, maybe next quarter or next year
goes the other way.
Yeah. So you really need to take that and strip it out. And so that's why we prefer the operating income part of the statement, because it's not there. So if you look at that, you see that, the number is closer to, $20 billion. And that's still huge, right?
Very respectable.
Very respectable. But it's much more in line with where it was a year ago than the initial market reaction. Now you go a step further and you say, well, look, as we talked about earlier at the top of our meeting, like what do the segments say? What does it look like? What does Amazon report? And to their credit, they really do a good job of like, they tell you, they say, okay, we have these three operating lines of business. We have this North American retail, we have this international retail operation. Oh, and we've got this third thing, AWS, Amazon Web Services. And so they give you sales, operating income of each of those businesses, current and historic, and they give you the property, plant, and equipment information for each of those businesses. So you can see how asset intensive those businesses are.
Right.
And so we've got a piece on our blog that goes through all of that, but just basically bottom lining it, when you look at those components and you look at the operating income part of it, you realize that almost all of the operating profit of this giant behemoth organization, at least 2/3 of it, you can say that with some degree of certainty, comes from Amazon Web Services. So these guys, as profitable as they are, and they are,
yeah,
most of that profit comes from running servers for other people to host web applications. So that's it.
That's neat. It's really neat. And I mean, it opens the door to a whole other way of seeing the firm now and valuing it. So if the consumer is soft, as an investor, as a long-term investor, you could, if you understand the components, do we really have to panic?
Right. Well, so you can think about it, in a, like if you're going to be creative about it, maybe one way to think about it, and I'm not saying this is the right way, just one way would be to say, okay, Amazon looks like Walmart, and this is what the operating metrics of that business look like. And then Amazon looks like Microsoft, and okay,
yeah.
So
neat.
Intelligent Cloud of Microsoft versus Amazon Web Services. With the way the world works today, you can actually, a relative novice, I don't recommend that novices do this, but someone with a little bit of knowledge can actually, compare businesses that way. Pretty cool.
That's neat. That's really neat. Well, terrific. So yeah, I mean, I think this is super interesting and neat. I'd love to maybe pick it up again at some other point.
Anytime.
This was solid. I'm starting to like rethink how we look at some of the variables we're looking at. But yeah, I do think this moment in time with the markets, the sort of interest rate sort of jitteriness that we're all facing, combined with the next chapter of COVID, whatever that is, hopefully it's good news, what have you, and then bring it all back to classic, the profit cycle story. So net, I mean, at Cirrus, we're constructive about equities. We do think, it's hard to see equities really get beat up if companies are making money. And we're still on the uptrend of the profit cycle. So, I think the interesting debate is whether or not this profit cycle that's growing is going to slow or accelerate. That's clearly important. And if the rate picture becomes front and center, then valuations are going to matter. So parts of the equity market that should work here are, if we take the rate picture, the uncertainty seriously, we have to become valuation sensitive. And if we're taking this sort of like haze on the horizon, the uncertainty of the maturing profit cycle, those elements are going to force a quality bias. So, I think we are constructive, but I think it is very choppy water still. And we are going to continue doing some more work on quality. We'll definitely have some more conversations on this. Thank you.
Thank you for having me.
Awesome. Well, thanks for joining us. That was Pranav Ghai. I've learned a lot. I hope you've enjoyed it, this segment. Clearly go to the Calcbench website to take a look at what these guys do. I definitely think if you're in the world of finance, trying to dissect this stuff, the financial statements in more detailed fashion makes a ton of sense, especially now with technology sort of helping us out along the ways. With that, this is a conversation series. It'll be filed on our website. It'll be sent out in some emails directly to our client base as well, but it can also be found on the YouTube Cirrus research channel. Thank you for joining us.